Yeah, so that's it. We're done and dusted. Another reporting season behind us. I think overall our companies fared pretty well. There were some nuances of how different this was to other reporting seasons we've seen in the last little while. I think the big one was in terms of expectations. We know that the Reserve Bank had been raising rates for the last, 18 odd months. So we were expecting the economy to slow. We're seeing that in the key data. And I think that's investors had that in mind when they were thinking about results as well. So expectations were reasonably low and cautious, and you saw that in the share price moves of lots of our companies before they even reported. Almost every company that was scheduled to report through this reporting season had share prices that fell in the sort of 2 or 3 weeks leading up to their announcements. So clearly there was caution there, and I think that also led to a little bit less forgiveness than usual. So what I mean by that is any company that came out with a result that disappointed market expectations, which were already reasonably low, got punished pretty hard. And we saw that in the discretionary names in particular. The likes of a Kathmandu or Air New Zealand came out with some disappointing guidance and numbers. So we saw their share prices get hit pretty hard on the back of that. But overall, I think when you think about how tough the economic backdrop is, our companies, I think, came out reasonably well, and they are in pretty good shape as we head into the remainder of this year. The recent OCR announcement that rates aren't going to go any higher will provide some relief, but I guess the bad news is that they're not necessarily coming down either. So that's going to be the key influence to watch over the remainder of the year, is what direction interest rates and the key economic data take. So as I've mentioned a few times now, I think the key theme was really the cost rises that we're seeing from many of our corporates. We're seeing inflationary pressures throughout our own daily lives. The companies that have reported are showing some of those same pressures, whether it's their debt costs, whether it's labor, whether it's rents, insurance, the cost of the goods that they sell. All of those things are going up in price. So that was a real key feature throughout this reporting season, as those costs are continuing to rise, and that is putting pressure on margins for a lot of companies because they're not able to pass on the full extent of those cost rises that we've seen in the last little while. The other things, I guess, this is the first time in a long time where monetary policy is kind of working against companies. And what I mean by that is generally we've had interest rates that have been falling for a long time. This reporting season was probably one of the first times where we've had the Reserve Bank trying to tighten things, and we've had results, be reported with that backdrop, and that's made things a lot tougher. And we saw that with the level of consumer demand and the depressed level of demand for lots of our companies, their goods and services that came through as well. And then I think finally, a unique one has been the wild swings in demand for the goods and services that our companies sell. If you think the last couple of years, demand for pretty much everything was through the roof, as long as you were in those right sectors. Obviously, hospitality with lockdowns was the other way, but you've had to, as a business, for the most part, deal with really strong demand, and now probably swinging completely the other way of pretty benign demand. And to try and resource up your business, whether it's labor, whether it's inventory, all of those things, and get it right in a really volatile demand environment is quite a tough ask. So I think that's been something that's new for a lot of companies, and many of them have struggled with that, which you'd expect because it's really hard to be dynamic through these periods. But overall, I think they're doing a reasonable job of keeping on top of those things. And then I guess lastly, the key theme is probably just divergence. The haves and have-nots throughout this period, and anyone that's exposed to discretionary spending has really been hit hard in terms of earnings downgrades, and those that are a little bit less sensitive to how the consumer is feeling, the demand environment, those have just posted reasonable results and got on with things, even increased their dividends. So there is that real divergence between ones that are exposed to the domestic economy and those that are less exposed to that, and throughout these results. If you think about the last 6 months from a demand environment and an economic backdrop environment, things have been pretty tough. One of the toughest periods, I would say, for our companies, and they've come through reasonably unscathed. We haven't had major shocks. There's been the odd company that's come out with big downgrades, but it hasn't been completely terrible if you look at things overall. I guess the positive is that if we look forward now, we can see an environment where interest rates start to walk down a little bit, and that will provide some relief for the corporates. I guess the negative is that that's not happening tomorrow. The Reserve Bank has come out and stated that they're going to stay at these levels and likely stay at these levels for at least the short term. So that's probably the bit that a lot of our corporates have to contend with. Is you've had a really tough 6 months and probably some of the toughest you've seen in a little while, but that relief, which is eventually going to come, isn't going to be there in the next 3, 4, 5 months, I don't think, in terms of that demand environment improving. So, the good news is that most of our companies are right-sized, and they did that through COVID. That was a big shock. So whether it was in terms of their cost bases, whether it was in terms of their balance sheets, in terms of the debt that they've got, people got their house in order. For the most part through that period. So we are lean and fighting fit as we go into this tough period. That's not to say there aren't some companies with probably a little bit too much debt, but overall, I think our corporates are in pretty good shape to navigate through this next little while. And then you've got that light at the end of the tunnel that the Reserve Bank will ultimately start to cut rates, and that will make consumers feel a little bit better about themselves, and that demand for goods and services start to come back to what is a more normal level that we might be used to. Yeah, I think our strategy is probably two-piece. So there's a short-term strategy, and in the short term, I think we are very much defensively focused and looking at those companies with those defensive characteristics. And what does that mean? Well, we're looking for companies with stable demand, lower exposure to the fortunes of the domestic economy, good debt positions, but also some structural growth to their businesses. So think about the electricity companies, the telecommunications companies, whether it's a Spark or a Chorus, some of those infrastructure names which are difficult to replicate, all those real solid defensive assets and businesses that we like. I think those will be the ones that we will gravitate towards in the short term as the economic backdrop is uncertain. Then as we step forward, I guess, into the medium term, we can again be confident that interest rates are going to come down. The timing is the nuance thing, and I think the Reserve Bank is talking 2025. I know market pricing at the moment is probably for later this year. It depends how that sort of shakes out, but it's very much a case of when, not if. So we know it's going to happen in time, and as that happens, we will start to see, I guess, a better environment for equities and for asset prices in general. That's what happens when interest rates come down. So those interest rate cuts will take some pressure off borrowers and companies with high levels of debt. They'll help stimulate growth because everyone will feel better about themselves, that their costs of mortgages and things like that are coming down. Asset prices will start to rise. And more importantly, I think the key one for equity investors is going to be that it'll make savings relatively less attractive. And what I mean by that is, as interest rates fall, that means the term deposit rate that you're receiving will fall as well, and that starts to, the balance between getting a return and risk assets like equities becomes more attractive when your sort of term deposit rate is starting to fall from very elevated levels at these points. So that's what I think we're thinking about in terms of the medium term, is when does that pendulum sort of swing the other way? And markets are forward looking, so they will step ahead of any interest rate cuts. And I think you need to be prepared for that and look for those opportunities where companies will get some relief from falling interest rates, and those companies that will benefit from a consumer that's relatively more positive as we step through the rest of the year.